I'm Ben Reppond. Welcome to my YouTube channel. Today is January 1st, 2025. Happy New Year to you, and I hope it is a prosperous one. I hope this past year was good to you in your investing, and I certainly hope the same for this coming year. I will use my channel to be able to provide you with information that is helpful to people who use different types of approaches. I'm upfront about the approach that I use, but my goal is to be helpful and educational. So we will get into the dashboard and talk about what happened this past week, and I'll give you my comments on it. The week before this past week, everything in the yellow box, meaning that previous calendar week, was negative. I hadn't seen that in a long time. Now everything is positive except bonds. Bonds continue to decline, meaning bonds, what I'm saying is government bonds, and specifically the long-term government bond. All the other equity indexes are positive. 4 U.S. indexes, developed markets and underdeveloped markets. When you go over to the right of that, you'll see the year-to-date numbers, and this was good. This was good for this year. You say the NASDAQ 100 up 27%, the S&P up 25%. This is above the mean. So, and then of course the Dow Jones, Russell, and so forth. But it was a better than normal year for the equity markets. However, when you look down at the bottom, the long-term government bond, which is not all bonds, there are corporate and intermediate-term government and short-term government, etc. But the long-term government bond, which does, by the way, perform the best in positive markets, is down 11.9% for the year. So if you're in a 60-40 portfolio or some kind of portfolio that uses bonds or uses government bonds, whether they be short, intermediate term, long term, or whatever, and some corporate bonds, you know that the bond portion of your portfolio is hurting you. It's pulling down that rate of return. But that's what you sign up for when you're in a buy and hold or 60-40 type portfolio. To the right, you see the green dots and red dots. Green dots are those that indexes that are above their 20-day moving average, and the red ones are those that are below their 20-day moving average, kind of signaling a positive market for that particular index. When we take the S&P 500, tear it apart, and this is as of last Friday, and look at the 11 sectors, 11 component parts of the S&P, you can see where that stands. And because last week was negative, this week was mixed and not as positive, but generally a little more positive than negative. That first column of red dots, every single index was below its 20-day moving average. And then you go on over from there, and it becomes a little more positive the further out you go. But when you get all the way to the 200-day moving average, you still have 4 sectors that are below their 200-day moving average. In the center, the yellow box shows that what happened last week with the sectors. Only one sector was slightly negative, which was consumer staples. All the others were positive, the most positive being technology and real estate. Okay, this is a picture of the S&P 500 line chart, and I put a line in here from October of 22 to present, so this would be a little over 2 years. And the general direction, the trend, is still in an upward direction. You see the little tick at the end, it stopped coming down and went up just a little bit. But it basically is still in an uptrend. It has not broken the trend line. I put that on a candlestick chart so you could see, and the hollow candlesticks, hollow candles, are generally, those are positive. It starts here for the week and ends here. The hollow part is the difference between those two. The reverse of that, when you see a red candle, it indicates that it started here and it went down for the week. There are a lot more, for that period of time, a lot more hollow candles than red candles. This is a relative strength chart showing the NASDAQ 100 versus the S&P 500, 30-month chart. So if it goes up, it favors the numerator, which is the NASDAQ 100. If it goes down, then that would indicate that the S&P 500 was stronger than the NASDAQ 100. And you can see over this period of time, it does go up and down a lot on a weekly basis. But overall, I draw the black line to show you that in general, the NASDAQ 100 has been stronger over most of that 30-month period. Growth versus value. So we see the big move at the end, the far right of the chart, the big move up, again, relative strength, indicating that the numerator is in favor, which is growth. Growth has been strong lately, which is generally, those are technology stocks, and still kind of went up a little bit at the end, but has been quite positive for a little over a month. S&P 500, the largest 500 companies on the stock exchange, represented by SPY, the S&P 500, numerator, small cap, smaller companies, not those are large, smaller companies, the Russell 2000 small cap index, that is the denominator. So when it goes down, that means that small cap did better than large cap and vice versa. So in general, large cap, including the most recent month or so, large cap has been outperforming small cap. Bonds, as you saw in the earlier data in the dashboard, you can see bonds continue, in this case, the long-term government bond, but I think it would be true of all bonds or most bonds, continue to decline. Why? Interest rates are going up, therefore bond yields are tending to go up, which means bond prices have to fall. So not a very pretty picture for bonds over a 5-year period of time. So if you're an investor, many investors have bonds or they have bond funds. So this is using a bond fund or bond ETF, but the value of it has continued to decline. Another reason I don't use 60-40 portfolios, because these times do happen. The US dollar continues to rise. Look at that at the end of the chart for the last couple of months. Wow, what a good move that is for the dollar. Very positive. So this makes it harder for foreign investors to invest in the US because they're investing with devalued currency, and it's more favorable for US investors or people who are spending money overseas because the dollar is stronger and goes further in those markets. Gold is coming down a little bit, had a rally and then an attempt at another rally, and then it's I won't say collapsing, but it's pulling back for sure, down kind of at its 20-period moving average. Silver is weaker. It is also coming down, similar to gold, but it has gone through its moving average and is moving down. Still overall has had an uptrend, but right now it's showing some weakness. Bitcoin has been on a rally. It pulled back a little bit in the last week or two. You can see that. And volatility. Now, volatility goes up and down. It generally measures negative volatility. So when it goes down, that means less volatility in the market, usually more favorable to equities. Vice versa, when it goes up, there is more fear in the market, meaning you could even call it a fear index, meaning that the equities tend to be going down. So kind of inversely correlated with equities, generally speaking. Asbury 6, the metrics on Asbury 6, what's interesting is last week was a very negative week for equities. So, well, equities and bonds. And it was negative. All 6 were negative last week. This week was more positive than negative, but it's still, all of these indicators still stayed negative. Interesting. Okay, comparing assets. And there's only 4 of them that have that are stronger than the class they're compared to in the last week, the last month, the last quarter, which are the 3 periods moving across the page. So the U.S. is stronger than emerging markets. Emerging markets are definitely weak. And then in the bond area, government bonds are stronger than corporate bonds. And you saw how weak government bonds were in that bond chart. Corporate bonds are weaker. High yield is more favorable than high quality. Short term is more favorable than long term government bonds. U.S. versus the world. No country is better than the U.S. in all 3 time periods, week, month, and quarter. The U.S. is more favorable than some countries in those 3 time periods. Those include Brazil, Peru, Mexico, Taiwan, South Korea, and India. And then because a number of countries kind of moved up into that better than the U.S. this past week, that knocked some of those choices out of there. So I've been showing U.S. versus South Korea because it's really a smooth chart showing a lot of U.S. strength relative to a foreign stock market, in this case, South Korea. But it also is indicating that South Korea's stock market is doing poorly. Imagine, our reference is the U.S. market. Imagine that make South Korea the numerator. Wow, that would be a very negative chart. And but that's really what's happening. Okay, gold and silver. As of last Friday, December 27th, gold was down 0.2%, down to the spot price of $2,622. Silver is $29.62, down 0.4% from the previous Friday. The gold-silver ratio is still 88:1. When you look at a monster box, the monster box is 500 rounds of silver bullion, pure silver, almost pure silver, $15,345. That is the spot price plus $1.07 markup. That's a pretty low markup by historical periods, at least the ones that I've seen over a long period of time, bringing the price per round up to $30.69, including the markup. That's a courtesy of my son, Preston. Okay, well, this speaks for itself. Chairman Powell is making the case for his rate cuts. You can see the reaction. Thank you for watching. If you have questions or comments, leave them in the comment section below.